Hello everyone. In this session we're covering the basics of revenue recognition for services that are billed and paid for in advance. Understanding how revenue recognition works can help sales and service teams make better decisions and support business growth. Let's have a look. Exactly what is revenue recognition? Simply put, it's the process of determining when a sale can be counted as earned revenue in our accounts. This presentation will focus on situations where services are billed in advance but delivered over time. While it might sound technical, understanding this concept is valuable for planning, budgeting, and aligning expectations. Revenue isn't always recognised the moment we send an invoice or receive payment. Instead, revenue is generally recognised when the service is delivered. This approach ensures our accounts accurately reflect our business performance. For example, if we invoice for a service in October but deliver it in January, we don't recognise the revenue until January. This follows accounting standards like UK GAAP or IFRS 15, which guide how we handle these transactions. Let's bring this to life with an example. Imagine we invoice a customer for a training course in October, but the course itself is delivered in December and January. Although we received payment in October, the revenue is recognised over the course period, meaning part of it is counted in the old financial year and part in the new. This approach provides a clearer picture of when the value of the service is actually delivered. One last example to reinforce the concept. Let's look at an annual membership paid in advance. If a customer pays for a full year in January, the revenue is recognised gradually, month by month, over 12 months. This way, the revenue aligns with the delivery of the membership, providing a more accurate view of our performance across the year. This way of recognising revenue has a big impact on budgeting. When services are billed in one year but delivered the next, it's important to consider this carefully. In this example, the training calendar has a finite number of courses it can deliver. Let's say 10 in the year. If you have already sold but not delivered 2 in the current year, your budget with the current resource only has a maximum of 8 sessions it can deliver in the year that is being budgeted. Without adjusting for this, we could unintentionally overestimate the funds available for the new year. So planning carefully with finance to understand timing is key to making informed budgeting decisions. Why does this matter, particularly for sales and service teams? Well, first, it helps set realistic expectations with clients and managers about when revenue will actually appear in our financial statements. Secondly, it makes budgeting more accurate, avoiding surprises later on. And thirdly, and perhaps most importantly, it helps us understand how resources are being deployed and gives us an early warning as to when resources may be in surplus or deficit. We can then plan to maintain optimum levels which balance profitability and company ethos. Finally, it prevents us from mistakenly counting revenue as immediately available, which can also lead to issues with planning resources. So what should we do differently? What can we do differently to support accurate revenue recognition? Start by coordinating with finance on your project timelines and delivery schedules. When discussing budgets, be mindful of when services will actually be delivered, rather than just when they're invoiced. And remember, updating forecasts regularly can help keep everyone aligned on revenue projections. Let's recap the main points. We should recognise revenue based on delivery, not just invoicing. Understand how this affects financial statements and budgets. And finally, make sure to coordinate closely with finance, especially for services delivered over multiple periods, so you can plan effectively. Thank you very much for listening, and I hope this gives you a clearer picture of revenue recognition and its impact on our work.